Hey everybody, President Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending March 22nd, 2019. I call this market freakout. This week we saw the Dow, S&P, NASDAQ, Russell all moving lower. The Russell had the worst week, 3.1% to the downside. Of course, we saw the CBOE volatility index, the VIX. It moved up 27.9%, so call it 28%. It moved up to close the week out at 1648. Also on the world markets, we saw the FTSE down about 29 basis points, the CAC 40, which is the France index, down about 2.5%. DAX was down, the German index, 2.75%. And then we had slightly up moves in Japan and China. For the week, the worst sector performer was obviously the financial sector. It was down almost 3.5%, 3.36 actually. Technology just barely eked out a gain, one of the few gains in the week for sectors, although utilities was slightly behind. Technology came in about 0.55%. Or 55 basis points for the week. Also, we've got the current PE ratio, forward guidance of about 16, a little over 16.1, something like that. This time last year, it was about 18. So we've seen a reduction of about 10% in valuations on a go-forward basis in PE ratios. Excuse me, I got a cough here. So market freak out. How come? Well, we saw the bond market kind of enter center stage this week. Now, we've had over the past decade some of the lowest volatility in bonds and currencies that we've seen. But this past week, we saw the 3s over 10s, that would be the 90-day T-bill, actually invert and move higher than the 10-year Treasury, putting a little bit of worry on the markets. In fact, all across Europe, we've seen PMIs contracting at the fastest rate since about 2012. The German 10-year Bund, which is the equivalent of our 10-year Treasury, fell below zero for the first time since 2016. So we're seeing some agita come into the markets as well as slowdowns across Asian markets, rising debt loads in China. We've even seen the PMIs coming in here in the US as well. So we're seeing a little bit of concern coming back into the market. I don't see anything on the charts that I look at, as well as the credit markets, that tell me we'll have a recession this year. But keep in mind, when you get an inversion, this is the 90-day versus the 10-year, but another very widely followed is the 2-year over 10-year. Treasuries, and that is not inverted. It's down very close, but it has not inverted. It's up about 11 basis points, 10 basis points, something like that. But typically we see a recession anywhere from 6 to 8 months out to a year and a half from the move lower. And going back in time, if you look at the markets, you'll see that the markets always manage to move higher after we've had a yield inversion for the next 6 months to a year before really getting into trouble. So that tells me we still have a little bit more oomph left. But the markets on the initial inversion always freak out. You can go back in time and you'll see that the markets just have a tendency to do that. The other thing that we saw as a freak out this past Friday is the probability of a Fed rate cut by this December actually moved up. It almost doubled from the previous week. Now there's a 58%, greater than half, that the Feds are going to cut the rates before the end of the year instead of raise them. So all this really leads to the fact that the Feds probably made a mistake last year. They raised their rates a bit faster than they really should. And then they had that abrupt policy shift earlier this year, January the 4th, just kind of in their own way admitting they made a mistake. So now they're pretty much on the sidelines, at least their stated fact that they're on the sidelines through the rest of this year. But you know, the Feds aren't alone, guys. We had a policy U-turn in Europe as well. The ECB a couple of weeks ago came out and said they're going to launch new stimulus to support the Eurozone. And how are they going to do it? Well, what they're going to do is they're going to offer really cheap loans to banks because they want to get that money circulating through the countries there in the Eurozone. They're going to keep their interest rates at a minus 40 basis points, at least through 2019. You know, so that definitely sends signals to the currency market. and the global bond market that everybody and their uncle sees the economy slowing down. So this is why the Feds really, rather than reading the tea leaves last year, they were kind of like being like what we call the rat brain trader. They were adjusting their policies based on headline numbers, meaning by the time you read a headline on something, you're already too late as far as the markets go. So the Feds, the one thing good though that they did was they are willing to admit a mistake and do that abrupt policy shift early this year to really, get the markets going. But that caused a V move. We haven't seen that in the Feds. Usually Feds, it takes them 6 months to 9 months to realize they made a policy mistake. But this time it took Power Ranger Boom Boom Powell 4 weeks to realize that he goofed. And the bond market, as usual, and the credit markets always lead the way, as I'm always telling our members. You got to follow the credit and bond market. You got to understand what you're looking at there, and it'll give you a pretty good idea of what we can expect from equities. The other thing that we saw, there's some conflicting signals out there, of course, but it does show everything shows things are slowing. We got the Conference Board Leading Economic Index, the LEI. It came in and actually went up in February for the first time in 4 or 5 months, but the increase was slower paced, showing that we can expect slower growth through the rest of the year. Now, the LEI, the economic index, leading economic index, it is composed of about 10 economic indicators, of which the yield curve is one. It does take that into account. But keep in mind that in previous times when we've had yield curve inversion on the 90-day over 10-year or the 2-year over 10-year, which tends to be more popular, although the Feds tend to follow the 90-day over 10-year a little bit closer than the 2-year over 10s. It's still markets have 6 months to a year and a half of a run before it really caps out. Okay, and that's just the tendency of the market to get really giddy as interest rates come in. It's very cheap for corporate debt, so all large U.S. corporations are just, taking advantage of this by either restructuring some of their balance sheet, repurposing their balance sheet, or just really borrowing to fund acquisitions or other things that they want to do. And a lot of it now is moved over to Europe. Europe is starting to get a little bit more with the times as far as supporting corporate debt. And besides, the interest rates in Europe are a lot cheaper than they are here in the U.S. And granted, they're cheap here, but they're even cheaper in Europe. So we're seeing a lot of huge influx in 2018 and 2019 in corporate borrowing. So what that does mean, though, guys, money tends to follow the easiest path. And right now, the easiest path is the equity markets with the interest rates as low as they are. But that does tend to create asset bubbles where you get the bid up in price on assets beyond where their fundamental value curve should show they should be. So that's just the nature of a capitalistic economy. That's what we can expect. Also, we got Q1 earnings coming up in another couple of weeks. Keep in mind, the numbers are already priced in pretty low because there've been, I think about 70% of the companies have already lowered their guidance for Q1. That's a record number. But everybody's already got that built into the price right now. But what everybody wants to see is where's their forward guidance for the rest of 2019. And most companies, from what I can see, will probably lower their guidance only to lower the bar. Because remember, if the bar is lower, it makes it easier for them to hit their numbers. It's almost like you kind of defining what is par for this 18-hole golf course. You can set par, rather than 72, make it 150. So if you're a bad golfer, you're always shooting par. So, and that was an interesting story because Willie Nelson, on a side note, bought a golf course in Texas, and he tripled par. What each course was, each hole was, so that he could always show that he's a scratch golfer. So anyway, that's kind of what we're looking at this year. If you look at the screens, what you can see here is I've got a daily chart of the E-mini S&P 500 futures. You can see, as I was referring, that huge V, which is very rare. And this one was caused by Boom Boom Powell. December the 4th was when we started this huge correction. all the way down to the 2018 lows. You can see the 2018 lows at 23.16 on the futures intraday, December 26th. Then as the markets kind of opened up and it started to dip down right on January the 4th, right at that low on 2019 at 24.38, he basically came out in reverse course to pretty much give guidance after the FOMC meeting that we're going to sit on the sidelines, and then boom, off we went. And we're now right back up kind of where we started before, just slightly above the December 4th. So we still have, I think, some more downside left. If I blow this chart up, I'm going to show you here. And I've been, talking to our members. You can see here we've got this bed set up. I call it a bearish divergence. And we call it's not a poor man's bed. We call it a regular bed. And there's differences between the two. But when we start to see this setup here, and we were seeing it really back on March 20th, and then the week prior, we were setting up what we call our FUBAR trade, which works really well in down moving markets, and the FUBARs were cheap. So we were able to just catch this. Now, you don't know the day that it's going to hit. You just never know. So what you want to do is when FUBARs are cheap, you set them up. And if you're not a member, I highly encourage you to come in. Just one good trade in the FUBAR to cover your cost for our membership for an entire year. But this was low-hanging fruit, guys. So we took the trade, did fairly well in it. Now, the value area in this is sitting right around 27.82. You can see this yellow line, which is where the highest volume of buyers and sellers, they were equally mixed, going back 90 days, which is 1 quarter's worth of data. Trading data puts us right at about 27.84 area. So would not surprise me to see us pull back just a little bit more. Breach the 2800. We'll probably get a little bit of a scare. You can see these are EMAs, not SMAs, and you can see on here we've got a cross in the 50 and the 200 on the EMAs. On the SMAs for the moving averages, it has not crossed yet. Okay, so we're still some caution in the wind for us, but you could see the movement here. I could see us pulling back. You can see if I just zoom out, you can see this shaded zone right here, which is kind of where we had problems before. We're kind of sitting right on that right now. And again, a little bit more momentum to the downside. We have a bounce back up, but I just think the momentum might carry us down just a little bit. Okay, and that's kind of where we're going to see here. I don't think we'll make new 2019 highs, which is at 28.66, possibly until we can start to crank off earnings, and just kind of see what the forward guidance is. And this will help large, big moneyed firms and the sovereign wealth funds that really move the markets determine what is the valuation looking like and what are they willing to pay. Now, as long as interest rates stay low, even if valuations come down, it's still going to be higher than the lower interest rates big money can make. So it's still going to favor equities over bonds. So we got to watch this really closely. Now, if I switch my screen and just show you the Bollinger Bands, let me come in here and just shift it over to right here. So now you're going to look at the same chart, E-mini S&P 500 futures, but I'm using Bollinger Bands and I'm using a 3 standard dev. So the red line is 3 standard dev from the center line, right? The purple is 2 and blue is 1 standard dev. All right. And if I were to blow it up like this, you can see here, well, before I do that, you can see in Bollinger Bands, for those of you that like to use them as part of your indication, when you've got contraction in Bollinger Bands, they lead to expansion, and then expansion goes back to contraction, goes to expansion, and then back to contraction. So you can see here we were starting to contract here in early March with this big move up off this little bit of a pullback that we had here that ended early March. And then boom, the first week in March, we had that, pullback where we moved down every day for the week. And then boom, we expanded back up. We moved up. And notice here that the Bollinger Bands really were expanding even though we were moving up because the markets were getting a little bit worried. We're moving up a little bit too quick. So from this contraction to this expansion here, and looking at the Bollinger Bands, if I were to blow it up, you can see I've got an Elliott wave count on here of a 3-leg, and a possible 4-leg correction takes us down to 2,700. Okay. And, and we wouldn't get there in one day, but you can see the candle here took us down almost to the center line of the Bollinger Band. And the last time that we pulled back from the 2 standard dev up, we moved down to the 1 standard dev below. And to do that now would take us right around to 27.75. And then perhaps we'll, see a little bit of momentum back up and then maybe another rollover. But I think we're going to be printing a 4 leg here shortly. And then that would move us back up to allow into Q1 earnings. So let's see how this goes. The RSI is still showing over the 50 RSI here. And if we look at the MACD, again, we got that divergence there that would indicate, and we got the divergence on that day or on Friday. It created the trigger in the divergence. So that means we can expect some weakness here. Not really taking out the 2019 highs that we made on Thursday, right? Until we see a little bit more clarity around what we're looking at. And then the other indicator I'll show you that I use with our members a lot is the Ichimoku. And if we look at the Ichimoku, same chart, same time frame, right? You can see here, I mean, obviously we'd expect the MACD to be the same because it's the same chart. But if you can look on here, you can see all of this support underneath in a green cloud. So that suggests we're still in a bullish frame of mind, guys. And these dashed yellow lines show what the Ichimoku is showing as downside support. And you can see the first one's at 27.46 and the next one's at 26.88. So I think this one is a pretty good support area here. And it would put us right on this cloud, right? And generally I'm going to be looking for the cloud to hold us up here on this Ichimoku chart. So there's a lot of congruence among all of these various charts. And in reality, once you understand one chart, your interpretation of the bias of that one chart will be the same across multiple charts. When you get a difference, and sometimes you do, then you got to play a little bit safer. But it's a good way to use different indicators to kind of match a bias as you develop the bias for what you want to do with a trade. Okay. So this is a little bit about where we're looking at for the E-minis. Now, another thing I wanted to show you here is let's look at the transports. Transports here is like a canary in the coal mine. Maybe not as important as it was in the early 1900s, in 1930s, 40s, and 50s, but it's still very important. And look at what we've got here. We broke the 50 EMA. And this is the EMA, not SMA, but EMA on the transports. And we're well below the 200. And on these EMAs, the 50 is still below the 200. Folks, this is more bearish, okay? I mean, it's kind of a bearish breakdown. We had an Elliott wave count of a 3, 4, and then we're coming up to hit a 5, and it broke down. So this could be a multiple count, wave count, within the 4 to 5 move here. So we could do an ABC and then a 1, 2, 3, 4, 5, and then an ABC, working our way back up. But we've got to watch this very carefully here. You can see volume over price here. The value area is about 187.73. We're below that. If I take it out to a weekly chart, you'll see when this comes back on the screen here, even on a weekly chart, the value area is about 188. So we've fallen below that. And then you can see this little green bar here. This shows where the least amount of volume took place, going all the way back to 2017 at the 180 area. So this will tend to act as a support point right around 180 should the transports, and we're at 180.80, right? I mean, we're like sitting right on it right now. Should we go below 180 into the high 170s, and it's going to get a little bit uglier for the rest of the equity market. Remember, the transports tend to lead the way, okay? The other one that tends to lead the way is the Russell. If we look at the Russell, you can see here that we made a high in the Russell on February 25th. Now remember, we made 2019 highs on Thursday of this week in the E-minis, and we made highs of I think Friday or Thursday in NASDAQ as well, right? We'll take a look at that in a second. So the Russell is doing exactly what it did in September of last year. It made highs well before the Dow, the E-mini S&P, the S&P, and the NASDAQ, and then it started rolling over and kept going lower. Meanwhile, the others made highs about 3 or 4 weeks later and then followed the Russell down. So now look at this on the Russell. Let's blow it up. Just like the transports, you can see here in the Russell where the 50 is still below the 200 and the price is just blown right through the 50. You can see over here the 50 held us up. Over here, back in January, the 50 held us up for almost a week, and over here it took about a week to break it. So that was a good bullish move and a good way to, pick up some longs here in the rut. But now look at it. Now that we broke this suggests we could get ugly quick in the next week or two leading into Q1 earnings. Notice here we may have a retest of the 50 EMA, and if it's a retest fail, we're going to go lower, guys. And if we look at the value area here, let me put it on a weekly chart just to kind of lay this thing out. Give it a little bit of time here. You can see here the weekly on this one, and let's go back to the Russell index because this I'm looking at the newer indicator here, the new thing here. But look at it. Here's the value area. The value area for the rut is around 1536. The support area underneath is right around 1444. And then we got another value area around 1406. So we could literally drop another 100 points in the rut on this chart. And all we could be doing is forming an Elliott wave, a 4-leg pullback, and then a move higher, and finally topping out before we get to our big pullback that we're expecting sometime later in 2020. I suspect that's kind of what it would be, right? So let me just change this here on the screen because I just noticed this. Sometimes I hit save and I think I'm saving it. Other times I don't. So anyway, this is where we're looking here on the Russell. So these are two that really concern me. If we look at NASDAQ, you can see here in NASDAQ, we did hit a high on Friday, and then we sold off. Early high, early in the morning, then we sold off. So NASDAQ was high on Friday. S&P had the 2019 highs on Thursday. Russell had the 2019 highs in February. All right, so just remember that, okay? Russell led up with highs, and it could lead down with highs. The other thing I wanted to show you, let's look at QQQE. That's the equal weight of the NASDAQ. You can see here that we've got a bearish divergence on the QQQEs. Now, the QQQEs, meaning equal weight, the Facebooks and the Netflix and the Amazons of the world have the same equal weighting as all the other stocks in NASDAQ, right? Most of them are small cap, and you'll see that the FANG stocks account for like 30 or 40% of the entire move of the Qs. Now, if we look at just the Qs, with the E on the end, so if we just look at the regular Qs, you can see here, and I put my cursor down here, there is no MACD divergence. So what is that telling us? That's telling us that the FANG stocks have been responsible for most of this upsurge here over the past 3 or 4 weeks. And now I think they may be running out of gas just a little bit and will pull back. In fact, I've got a FANG index here that shows you, we made the highs here on Thursday. And now we had this abrupt pullback here, and there is no MACD divergence in the FANG stocks, but there is in the QQQE. So that means underlying weakness outside of the FANG stocks in NASDAQ, and we can expect a little bit of a pullback. So these are just some of the indicators that I'm just kind of showing. Normally I'll show just members only, but I just want to show you a couple of these things. There's others out there as well that we use to gauge where we're going and how we trade. And of course, if we look at the VIX, you'll see here we're clearly back in the yellow zone again, okay? As I said, when we're in the green, we want to be looking at foo bars, and then we look at our other charts to see is the timing right to pick up a foo bar. And we were picking it up, and it did really well this past week. In fact, Friday was a good day for our foo bars. And now you can see here it's moved into the yellow. The back in early March when we had that week where every day was a down day, it moved up to 1840, the highs. Now we're, we closed the week at 1648. Now, if we look at the term structure of volatility, if we look at the front month term structure, and we use this to trade volatility, you can see we're just barely in a contango environment because we're in the green here on the term structure. So this means that although we went into the red, back into a backwardation intraday, going into close, we moved back into a normal contango environment. So the market at this point in time, while we had a freak out on Friday, we didn't really do enough to really um, um, drive volatility into a freak out move. Now, if we look at the back month term structure, this would be May and June, I guess, or April and May, going out in time a little bit further. You can see we're even better structured in a contango environment. So again, going out in time, what would take us through earnings, there's not a lot of elevated worry out there. Why? Even though we're having some of these down moves, most of the market does not see a recession this year. And we're still in, as I tell our members, a buy the dip. Now we got to determine when's the best time to pick it up. We'll look at that for our members this Sunday night in our weekly market watch. But that's kind of what I'm seeing, right? And then if we come into our we come into some of our trades here that we're playing right over here. If we look at Treasuries, look at what Treasuries did. I mean, we just, boom, we're right up to where we are here. Now, I would be willing in this Treasury, I'd be willing here to look at picking up some shorts here in this, just picking up a couple of puts in TLT, coming back to a value area here of around 145.29. Okay. Can we go higher? Sure. If we look at the weekly chart and we look at where the value area here going all the way back, as I said, to the summer months of 2017 is at 143. So it's going to take a lot to really get us up to this next value area here of 153. All right. We're at a resistance point right now, slightly above that. If we come back down below 148.11, picking up puts here would be an interesting thing in the bond market. Okay. Now you can do it also in TLT. We'll be watching these going forward, but look at the interest rates. And let me just show you here on a weekly chart. We were at a value area of about 2.82, and then we just blew down below. And if you guys remember from a couple of weeks ago, 3 or 4 weeks, I said this is our target here of 2.5, and we actually came down. Intraday, we were down around 242, and now we finished the day here at 245. All right, so I suspect we're going to come back up to this 25 area, but the value area below is right around 233, and you can see here the least volume here was 246. So that's going to kind of hold us up a little bit. Can we go lower? Absolutely, which would drive bonds a little bit higher. If we come down to this value area here, again, where the buyers and sellers were in equilibrium around 233, I would be looking at being a buyer here. I don't see interest rates going much lower than this over the near term. Okay, but again, if we go back to the daily chart, this is what I was pointing out to our members here. We had this 3-4, and then I said we're going to print a 5 leg, and it'll probably take us down to 2.5. And sure enough, it went down. It touched it on Thursday, and then it went below it on Friday. But that was our target, 2.5. So for folks that were following our trades in that, we did fairly well. Now, if we look at currencies, obviously the pound is staying within the regression channel, moving up. All right, it's a very wide regression channel. You can see here the reading on the regression channel is 0.82. So the higher the number, the tighter the spread. Because it's 0.82, it just means it's very choppy, meaning you want to be selling around the blue and you want to be buying around the red. You can see the value area here is probably going to print a new value area shortly. If I go out to a weekly chart and we take a look at it, you can see the value area on the weekly is about 131. We finished the week at 132. So, if we come back into this and we come down to this area down here in the lower percentile range of this regression channel, then I'm going to be more apt to be a buyer. I don't want to buy up in this area up here. Okay. And then if we look at the euro, the euro, it's, that, by the way, the euro, with all of their loose policies and interest rates, their intrabank lending rate at minus over 40 basis points, it's really low. I don't see any impetus for the euro to go much higher right now, although we're kind of sitting almost right on a value area here of about 113.6, right? That's kind of where we're sitting here. I think the near term suggests a little bit lower, but anyway, be that as it may, if we look at the dollar index, remember it's an index. So the dollar doesn't move on its own. It's an index composed of about, six other currencies, of which the euro accounts for about 58%, slightly below 58% of the value of the dollar. And then the yen and the pound make up between them collectively about, 25%. So between the yen and the pound of 25% and the euro about 58%, that's pretty much the dollar. And the other currencies, the Canadian loon, the Swedish krona, and the Swiss franc make up a little bit, but not as much. The Canadian dollar just a little over 9%. So how those indexes move determines. Think of the dollar index like a dollar ETF, if you will. But this kind of shows we've been in this wider range here. The value area is about 96.75. In times of stress, the yen moves higher, right? If we look at the yen, you can see here the yen currency right here, starting in early March, it's been gradually moving, inching higher. In times of global stress, the yen moves higher. You can see in Q4 when we really, especially December, this is the December month, how the yen just totally went ballistic, straight up, right? Money rushes to the yen in times of stress. And then obviously January, February, March have been very bullish for the global markets, especially the US, and you can see the yen has come back down again. But now it's starting to come back up. So we've got to keep an eye on the yen to see it's just one of the things that we're looking at. If we look at oil, right, and this is a daily chart of oil, again, I'm not getting a lot of divergence on oil on a daily chart, so that suggests we may have a little bit more upside. I have said the mid 50s, that would be probably 54 to 56, 57 areas, kind of where it should reside. On a daily chart going back 90 bars, it shows us at 52.19. If I put it on a weekly chart just to look at where the value area is of oil, you can see we're sandwiched between a couple of them. One of them up here is around 68.5, and the other one is sitting right around 56.77. That's the one that I think is more conducive to where we are. And the lowest value is right around 60, which is where the resistance is going to be. You can see intraday or intra-week. This past week, we did move up to 60.39. And we closed at 58.97. But oil right now is going to be more about the global growth. All right. And I've said if it does move up steady into the 60s, then I would be willing to short it. If we come out on a weekly basis, and let me just show you the origins of this upsloping channel here, you can see here moving off the lows here in 2016. I mean, we were down around $25 a barrel. If that wasn't a screaming buy, I don't know what was. And then boom, off we've gone to the races. And then we finally, right up here, I was telling folks to get short in our group. We had a couple of people take the trade, made a really good killing on the trade. But then we sold off dramatically. Right up in this area is where the Morgan Stanleys and primarily Goldman Sachs came out saying oil was going to $100 a barrel. And obviously it didn't work out that way. And last time they made a call like that when oil was at $150 a barrel and they said it was going to 200, well, you guys know what happened. It fell dramatically. It was ugly, 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 ugly. It went in the opposite direction. and it forced Goldman to come out and revise their previous revision. So now that we were down here, now we're back up here, and Goldman is coming out saying it's going to go back up into the high 70s, right? So we'll see. But I want to see us break these things right here, these things, that long-term upsloping trend channel, that trend line, and then just kind of see where this thing plays itself out. All right. I've never been a believer in oil coming back up into even the high 70s. I just don't see it. The only thing that can do it will be an artificial move in geopolitical politics. Outside of that, I see oil and demand over the next year and a half staying steady to coming down a little bit. Plus, you've got all the electronic vehicles coming out, battery operated, and it's just going to put a really damper on oil, right? So, and we've got some geopolitical politics coming into play here. Members, this Sunday night, I'll go in a little bit of details on some things that we can do in the oil market. So that's what I'm seeing here. The other thing is gasoline. We're in the peak seasonality for gasoline. You can see this thing has been on fire. We had a target buy trigger right around here, and after December 26th, that was a screaming buy for gas up to the value area. And then once we blew through it, the next target is the next value areas, or a little over $2 a barrel, right? And if I put it on a weekly chart right here, you can see right here we had a value area. We went blowing right through it of 163, right? And then the next value area is sitting up here at 206. So I could see a lot of chop up here, but I'm going to be looking to short this thing shortly. It's going to be a great trade for us. I love imbalances in the markets like this. I love them. Let me show you one here. I'll give you a little interesting thing, and for our members, we'll be playing this sucker. Here's an imbalance in the Palladium market. You can see the move here to 1576.9, and then here is Palladium. It had a hard down day on Friday. I think it's going to come down to a value area here, but I also think it's going to come down to 236, right? If I put it on a weekly chart and we step out a little bit, you can see it's about an 18.38% move from this peak here down to the 0.38% fib node, okay? And it's about 289 points. That's $28,900 from the peak. But nobody ever shorts at the peak, just like nobody ever goes long at the bottom, right? You generally want a confirming move here. Once we get a confirming move in this, then we're going to jump on it. Remember, there are no options in the Palladium market, either in the futures. There is a Palladium futures, or an ETF, PALL, but it's just, if you can't short it, PAL, you can do the futures, but it's $100 a point. So it racks up gains or losses very quickly. If you look at this MACD on this weekly chart, it is a rocket ship. Anytime you hit 5-year highs, and this Palladium move right here, as I really step it out, you can see here, we're at the highest it's ever been. I see us coming back to this peak here that was made in 2001. Eventually, we're going to get our way back there. So that's why I love shorting when any commodity gets to 5-year, and this is all-time highs, right? I mean, it's really crazy. So this is something that for our members we're watching, and we're going to look at a play here on the Palladium market because I just think it's going to be a really interesting play. Okay, I think it's going to be a fun one to watch. Now, there's some others here as well. One that I'll just show you guys on this free update here. Let's take a look at lean hogs. Look at that daily chart of lean hogs. Now, we had another trade in lean hogs to the downside, and you never know where you're going to hit a 5-year high or a 5-year low. But in the commodity market, that plays by the elasticity of demand all the time, right? And hogs, unlike Palladium, has easy substitutes. If pork gets too expensive, well, then just eat something else. Eat chicken. Or if live cattle get too expensive, then don't eat as much meat, right? So the last time we traded lean hogs, it really got over 5-year highs, and we shorted it, and it turned out to be a really good trade. in the futures market. Okay. Now, if you look at lean hogs, I mean, we scatterbrain right up here. It's real, and this is a daily chart. Let's look at it on a weekly here. Looking at it on weekly, you can see these value areas here. So you can see we made a high here. Going back to the last time we were this high was 2014, summer of 2014. And it was on its way down then, but we were still at that high, okay? So you're looking back about 5 years. Ideally, I would like to see this come up a little bit higher. I'd like to see this get up, if it can, in the 105, 106 area. It's going to be very choppy here, but the odds favor shorting lean hogs. And our mantra back then when we were shorting it for our members, we made a killing on it, was when pigs fly, right? So we were I was telling our members, I was going, when pigs fly, we're going to short it. And certainly pigs are starting to fly right now. Now, keep in mind, it can go higher. This is when we shorted pigs right up here, and we shorted it all the way down. It was a monster trade, okay? Because we were at, all-time highs here. This was the swine flu that caused this. Now, we don't jump in and trade pigs all the time. Same thing with some of the other commodities like coffee and sugar and cocoa and some of these. But when you hit 5 or 10-year highs, or decade or all-time highs or all-time lows, you got to really pay attention to it, because it's an opportunity to, because it's a commodity, people stop using the stuff. It tends to move the product in the other direction when it's low or when it's high. And when it's low, people start using more of the stuff because scarcity of supply, farmers or growers of that commodity just stop growing it. And then the inventories dry up rather, and then all of a sudden the prices start moving up. So it's self-correcting. You've probably heard the term, the only correction for high commodity prices is high commodity prices. So we're going to watch pigs, and if we come back into the daily chart, this will be something that we'll be tracking, and I'm going to be talking to our members about. I still think maybe there's some more upside in this thing. If we come into a 2-hour chart right here and just look at really a tight move of hogs here, you can see it's just a huge, fast move to the upside. I mean, just barn burner up. Ideally, what would I like to see? I would like to see pigs come in a little bit and then make another run up here again. I'd like to get, now this is a divergence right here on the 2 hours. So this suggests it probably can give us that little bit of a pullback here, kind of like an Elliott wave 4-leg before we make another run higher. So this would be a counter trend move, but there's a number of ways to trade these elevated commodity prices like this. So we're going to be looking at this in our member room Sunday night. So like I said, folks, if you're not a member, I highly encourage you to come in. A lot of our trades, we do some contrarian things, but we try and line up the probabilities in our favor. And when you do and you get it, because the odds will be in our favor, you can make some pretty good money pretty quickly. All right, everybody, have a great weekend. Members, I'll see you this Sunday night for our weekly market watch. Take care, folks. Ciao now.